Hey, it's Mike over at Cross Country Mortgage, and it's Monday morning. It's the week of June the 9th. It's time for your Monday morning mortgage update. I always try to give you some insight on what's going to happen in the market this week. This is the first full week we've had in trading in a couple weeks, and a lot going on this week. A lot happened last week, so let's get right to it. Last week, we actually saw an 11 basis point sell-off, which means rates got a little bit worse, but really not much of a change. Most of that happened on Friday because the jobs numbers came in that showed more jobs are added to the economy. Even though the numbers aren't trusted, everybody reacts to it. But really, the biggest thing that moved rates worse, slightly worse last week was stagflation. And stagflation is when we have a contracting economy. A lot of the numbers came out with the jobs and the manufacturing data that showed the economy was contracting, and also inflation. The wages that came out on Friday showed wages went up 15 cents an hour average hourly wage. And that's a huge, huge jump. Typically, we see increases 4 cents, 3 cents, 5 cents. So 3 times what's normal. And that shows that people are being paid more, which is great, but it's inflationary, and that's not good for mortgage rates. So when you have a contracting economy and you have higher inflation, that's stagflation. If you have inflation and a growing economy, that's not bad. So we don't want stagflation to really linger, and that's the biggest fear with bond traders. And that's what bond traders are looking at, is what's happening in the economy, because that's where mortgage-backed securities are determined, trading of mortgage-backed securities in the bond market. So when we talk about what's good or bad for mortgage rates, it may be counterintuitive to what's good or bad for the economy. It's really from the perspective of what bond traders are looking at when they're investing in the bond market. Okay. So what are the things we're looking at this week that are going to affect rates? Tariffs and a lot of other geopolitical stuff, inflation, and then the US is selling debt. They do it every month. So let's talk about tariffs. This tariff war has been on for since Trump's been in office. And we've always said that we weren't going to see the impacts of tariffs probably until about June. Well, June's here, and inflationary reports are coming out this week, the CPI and the PPI. And this is a consumer price index and the producer's price index. So this kind of goes into the second thing that's going to affect the economy. So if we start to see the tariffs come in and now starting to impact what we're paying for things, that's going to impact mortgage rates. But the biggest thing with tariffs is probably the deal with China. A lot of expectations that the US and China are going to come to some type of a deal this week. And if they do that, that's actually positive for bond traders, because that creates certainty. They know what's going to happen. They know how to trade. They know how to put their money in or out of the bond market. And bond traders don't like uncertainty. It's not like the stock market, where the stock market does this every day. Bonds typically don't fluctuate that much day by day, and bond traders like to know what's happening long term. So if we get some type of a deal with China, and maybe even the other 170 countries that are kind of in limbo, at least some of those, China's the big one, that's going to create a sense of certainty with the consumer, with businesses, with bond traders, and that at least is going to lead us in a path where maybe we might get out of a lot of this volatility. But there's a lot of other things that are creating the volatility as well. Russia, Ukraine, what's happening there, the California, and all the unrest there, and how the administration is dealing with that with the governor. Other tariff news, as I mentioned, with the other 170 countries, the Musk-Trump conflict. I mean, all of this creates uncertainty, and that creates volatility with trading bonds, and that creates a lot of uncertainty in what rates are doing. So the second thing is inflation. I mentioned that a little bit. CPI and PPI are coming out this week. They come out every month. And we're really going to be paying attention to the consumer price index report that's coming out on Wednesday, because we're going to start to see the impacts of tariffs on that report. So if we see high inflation, that's bad for mortgage rates. If we see some confidence, some certainty, maybe some deals with China, maybe that'll offset the high inflation. We're expected these numbers to go up. And that's, again, not good for rates. The third thing, final thing, is U.S. sells debt. The Treasury sells debt to pay its bills, and they're going to sell 3 and 10-year notes, which could move the market a little bit depending how much appetite there is worldwide to buy our 3 and 10-year notes. The big thing is Thursday, the 30-year bond, because that matches the mortgage-backed securities, long-term securities, 30-year fixed mortgages, if you will. So if there's a strong appetite, if people buy those 30-year bonds then that could move rates in a positive direction. Overall, this week we really are leaning towards higher rates and lower rates. So I'm in a locking bias this week. Really not playing with anybody's money. If you're in a mortgage and your lender's telling you, "Hey, let's float," boy, I would really second guess that and just take one in the hand instead of two in the bush. Lock that rate in because there's going to be a lot of volatility. Could be a rough ride this week. Have a great productive week, and we'll talk to you soon. Bye bye.